Look at me. I want you to really listen to me right now. You have worked hard your entire life. You saved, you sacrificed, you passed up on the flashy things so that one day you could cross the finish line into retirement and finally feel secure. But now that you are standing at that finish line, or maybe you've already crossed it, a new kind of fear sets in, doesn't it? It is the fear of losing what you have spent decades building. You look at the stock market and your stomach drops with every wild twist and turn. You look at traditional savings accounts and you see interest rates that are so low they make you want to weep, barely doing a thing to protect your purchasing power against inflation. You are caught in a classic retirement trap. You need your money to grow because retirement can last 20, 30, or 40 years, but you absolutely cannot afford to risk losing your principal. So you start looking for a safe harbor. You start hearing about something called a money market account. Your bank might have pitched it to you, or maybe a friend mentioned it over lunch. And the question keeping you up at night is simple: what exactly is a money market account, and is it truly safe for your hard-earned retirement savings? Or is it just another marketing gimmick that exposes your nest egg to risks you can't afford to take? Let's clear up the confusion right now, because misinformation in retirement is dangerous. First, we must understand what a money market account actually is, and more importantly, what it is not. A money market account, or MMA, is a special type of deposit account offered by banks and credit unions. Think of it as a hybrid. It's a crossbreed between a traditional savings account and a checking account. It gives you the higher interest rates typically associated with savings, but it also gives you limited checking features, like a debit card or the ability to write a handful of checks every month directly from the account. But here is where so many retirees make a catastrophic mistake, and I need you to hear me on this. A money market account is entirely different from a money market fund. They sound almost identical, but confusing the two can cost you everything. A money market account is a bank deposit. A money market fund is a mutual fund. It is an investment product sold by brokerage firms. While money market funds are generally low-risk investments that invest in short-term debt, they are still part of the market. They are not insured by the federal government. If the market experiences a once-in-a-generation meltdown, a money market fund can technically lose value. A money market account at a bank does not have that risk. So, let's answer the big question: is a money market account safe for your retirement? The short answer is yes, absolutely, but only if you know the rules of the game. When you place your cash into a money market account at a federally insured bank, your money is backed by the Federal Deposit Insurance Corporation, known as the FDIC. If you open it at a credit union, it is backed by the National Credit Union Administration, or the NCUA. This means the United States government guarantees that even if your bank goes completely under, even if the doors are locked and the institution fails, your money is safe. But, and this is a massive but for retirees, that safety net has a strict boundary line. Federal insurance only covers you up to $250,000 per depositor, per insured institution, for each account ownership category. Let's do some tough love math together. If you are single, and you roll over a portion of your retirement nest egg into a single money market account at your local bank, and that balance hits $300,000, you have a problem. You are exposed. $250,000 of your money is completely safe, guaranteed by the government. But that extra $50,000? It is completely unprotected. If that bank fails, that $50,000 could vanish into thin air. Now, while the physical safety of your principal is guaranteed up to those limits, we have to talk about the hidden threat to your retirement. It is the silent killer of wealth, inflation. In retirement, you aren't just fighting to keep your dollar amount the same, you are fighting to keep your buying power the same. If your money is sitting in a traditional, run-of-the-mill savings account earning a miserable national average rate of less than 1%, you are actively losing wealth every single day because the cost of healthcare, groceries, and utilities is rising faster than your money is growing. Money market accounts help fight this because online banks and competitive credit unions offer yields that are multiple times higher than the national average. It gives your cash a fighting chance to keep up with the cost of living without exposing a single penny to the volatility of Wall Street. However, you must be on high alert for the traps and fees that banks love to hide in the fine print. Money market accounts are not meant to be used like everyday checking accounts. They are designed for your secondary tier of safety money, your emergency fund, or the cash you know you will need for living expenses over the next 1 to 2 years. Because of this, banks will often require you to maintain a higher minimum balance to earn that top-tier interest rate. If your balance dips below their requirement, say $2,500 or $5,000 depending on the bank, two bad things can happen. First, your interest rate can plummet to practically zero. Second, the bank will hit you with a monthly maintenance fee. Paying a $10 or $15 monthly fee completely wipes out the benefit of the interest you are trying to earn. Before you open an account, ask yourself these 3 non-negotiable questions. Is this institution fully FDIC or NCUA insured? What is the exact minimum balance required to avoid fees and unlock the highest interest tier? And how easily can I access this money in an absolute emergency? Your money market account should serve a specific purpose in your retirement master plan. It is your fortress for cash. It is the place where you park your emergency fund, your upcoming property tax payment, or the next 12 months of your retirement income bridge. It keeps your money completely liquid, easily accessible, and entirely safe from market crashes, while still earning a respectable return that respects the value of your hard work. You have spent a lifetime earning this money. Now, it is your job to protect it. Be smart, be disciplined, and ensure that every single dollar you own is parked exactly where it is valued, where it is safe, and where it belongs.